Hello, welcome back. My name is Joshua Belanger of CounterVest, and today we're going to talk about the ugly side of trading options. Now, I know a lot of people are making big bank, making $5 trades on trading options, but we're going to talk specifically about how this trader lost over $1 million, $1 million within hours. Not a good day. And they were right, but they were still wrong. So this is a good case study of understanding why options can be, well, not can be, they are messy. Options are messy, and how quickly profit windows can happen and disintegrate. And it's a good example of why systems are needed and how fast options can move. So let's take a look at what my case study is. We're going to take a look here at DQ, David Quinn. This is Daku New Energy. It's a Chinese ADR. And the reason why we're talking about this specifically is because yesterday I posted this tweet here. And what I was discussing was this unusual option activity. Now, I know unusual option activity has been recently the buzz. It's the holy grail. It's not. Unusual option activity can be useful. We're not going to go too much into depth. I have articles explaining why unusual option activity can and is not useful. And it's posted on countervest.com. But specifically what we're seeing and why this was meaningful is because this was an ADR. This is an under-the-radar name. All of a sudden sees a 500% increase in options traded, specifically on calls. Within minutes of the close, all of a sudden over $1 million in premium is purchased. That's suspicious. Well, taking a look here at the chart, well, even on a day where the market or where this was up on the day, this was we're seeing at the close at these highs more money betting prices would go higher. Well, they were right, but they were then wrong, right? Ugh, really ugly. So we're going to take a look at what I saw yesterday. So this was what came across the tape here, and what I was talking about in the tweet is all of a sudden within minutes of the close, we're going to just copy this real quick. They came in and 5,000, on the volume wise, 5,500 contracts traded. We'll take a look at that in a second. And they're coming in, they scooped all these up within minutes of the close. That's suspicious. Why is someone coming in late within minutes? They had all day to buy. All of a sudden they come in and they execute an order to buy $1 million. Well, if we take a look back here at the charts here and take a look at the news, well, it's trading higher because the company reported that it's completing an IPO process to trade on the Shanghai stock index. So that was the news and the little birdie. This was an arbitrage on information possibly, and this is why it's suspicious when you see something like a Chinese ADR or some of these smaller cap names, because that's where the information edge can lie. It's not trying to follow names in an Apple or trying to follow order flow in an Apple or whatnot. I mean, it's just noise. There are birdies out there that leak or information that happens that people get that have an assumption or are betting on that. So that's why it can be useful. But this is a perfect example I'm going to show you of why just following it is very unuseful, because oftentimes people who are buying this that have this information do not know how to, one, structure their trades properly. What we talk about, 3 important things to a trade, right? Thesis, trade structure, risk management. A lot of them are not understanding of how options work. And this is a perfect example. I imagine they didn't understand that this is going to sell off, but this is a good reason and a good understanding of why it can be useful in certain situations of understanding option or the positioning in the options market, but at the same time, how fast these instruments can move. So without going too much further, let's bring up this specific contract here. And what I'm going to do here is I am going to go to a 1 minute. And if you notice here, this is what I'm talking about, this big buy that came in on the volume wise. So without having to go through, because I can't show you all the time in sales, it would take us minutes to go through here. At 14:55, couple minutes to the close, all of a sudden we get a spike in this specific contract, which is the 80 call. They're coming in a little bit before then, but then all of a sudden we get this bigger buy that adds to it, and then some smaller buys that come in as well. And this is at this moment of time, 5 minutes to the close, all of a sudden $1 million of new money, new premium comes in and positions it. So they came in here and they're buying about $7.80. It doesn't really matter what they were buying at, but this is what I mean. This is over $1 million. This is about $1 million that they bet Now, in the morning, right at the morning, they're probably looking and high-fiving themselves. Even pre-market, they're probably like, wow, we're going to be able to cash out on this and make our money. Well, within minutes, not only does it drop, we're talking about what, 6, 7 candles there. Not only within minutes does that $1 million, that paper profit, evaporate, but minutes later they start to lose even more money, and this is probably where they bailed out. These big orders here, this is probably where they bailed out. So when I say when they lost over $1 million, it's because they didn't get out of their position. And not only that, they lost more because they lost these at end of the day at 285. They paid $7.80 for it. I mean, talk about being right, but completely being wrong. And this is what happens. This is what happens at times. Not only did the stock sell off as well, obviously because the calls went in, but this is where how fast profit windows happen. I've had this happen to me, where I've had a stock pop up higher and then fades off. And sometimes it's best to have your orders resting and be able to execute. Just because I've seen this it's kind of been a weird market over the last 6 months, if not a little bit longer. We get these pops higher and then it kind of sells off. So if you have your order there, a limit order, it executes as a market, it gets filled, and you get filled at that, and you're able to get out. So there's a few times where within the 1 minute that it's triggered, got out, and then it's faded off. So that's the ugly side of trading options. It's very messy. I mean, you are right, but then you're wrong, and you have this kind of loss here. And this is the bad side of it. I mean, this is a really bad day for somebody. This is $1 million. I mean, to have that kind of money to put on the position to make that bet, it's just not good. And this is somebody that has what they're taking a bet. And when we look here at the chart as well, the key thing that a lot of people don't think about is the reaction. They have this information. They think, oh, I have this information. The market's going to, this is going to make the stock move higher. Well, it gapped it higher and then it sold off. Sellers came in and hit it right away. That's the market. So the reaction is always something that a lot of traders underestimate. And that's why there's no edge trading earning releases, because even though what you think and you read is a good number and the stock sells off, you're like, why did it sell off? Or it's a bad number and the stock rallies. That's the confusion that happens to a lot of people. That's why it's just the reaction is something that can't be assumed. And the other thing too is that these people who are buying, a lot of them just are making very aggressive and very bullish bets that they're looking to take that 1 million, and they were probably thinking that it was going to go to 3 million, 4 million. I mean, a big kind of bet. So this is the ugly side of trading options. This is what happens. But the other thing too is that there is an edge and can be an edge following order flow. It's just following the right ones. This one is a ADR. So like I said earlier, I mean, this is something where you can get information and that's the edge. Information can be an edge. When you look at something like Apple, there's going to be no edge there because everyone's already involved in that. It's so heavily traded and focused on that there's just no edge. Edge happens when you look at some of these names that are not even on anyone's radar. For instance, this DQ one. So that is the ugly side of trading options. Listen, I hope you took something from this. That one, trading options can be messy. I know a lot of people, like I said, I mean, they're making their big money with $5. But if you want to make real consistent money trading options, you have to have a system, and it's not just about following order flow either. So I'm going to cut it off there. That's what I have for you today. Hopefully, like I said, you got a couple things from this. Let me know in the comments below what you think. Give it a thumbs up.